So let's talk about 2026. When you look at the commodities market, you see a really strange picture emerging. On the one hand, things look like they're cooling off big time. But on the other, precious metals seem to be gearing up for a historic rally. So what is actually going on? Let's dig in and break it down. Okay, so the big picture view comes from the World Bank, and they're forecasting a 7% drop in global commodity prices for 2026. Now, this isn't just a one-off dip. If this happens, it'll be the fourth year in a row the prices have fallen. That's not a blip, that's a trend.
And right here is where it gets confusing. If the entire sector is trending down, how on earth are some of the biggest banks out there calling for gold to potentially blow past $4,500 an ounce? I mean, it sounds like a total contradiction, right? Well, that's exactly the puzzle we're going to piece together in this explainer.
To really get what's happening, you have to look deeper than just the headlines. There are these huge structural forces at work. We're going to look at what's uniquely driving precious metals, and then we'll see how that compares to the pressures facing something like oil. First up, gold. That big rally we saw through 2024 and 2025, it wasn't just a flash in the pan. It's built on something solid, something that looks like it's only going to get stronger heading into 2026.
And this is the most important part to understand. This isn't about hype or speculation. This is a direct response to things like persistent global inflation and just general uncertainty about policy. You know, these are the big, long-term problems that are literally changing how the world's biggest players think about gold.
This quote just nails it. It perfectly captures the mindset of the central banks. They're not just buying gold as a quick, reactive hedge. No, they are fundamentally rethinking its job. They're treating it as a core, long-term asset to keep their reserves stable in a world that feels more and more fractured.
And this chart, this shows you it's not just talk. You can see major economies just steadily adding more and more gold to their reserves, no matter what the price is doing day to day. This isn't panic buying. It's a slow, deliberate strategy, and it creates this incredibly powerful floor of demand for gold. So what does all this mean for the price? Well, if you average out the high-end forecasts from the major banks for 2026, you land right around $4,700 an ounce. And some models are even pointing towards $5,000 if the current economic climate continues. And that's without any new major global crisis.
Now, let's move on to silver, because its story might be even more powerful. Gold has its one big driver, right? Well, silver has two massive forces pushing it forward at the same time, which makes it one of the most interesting stories in the entire commodity space.
Yeah, think of it like this. Silver has two engines. The first engine is that it acts a lot like gold. It's a safe place to put your money when things get shaky. But then it has this whole other engine. It's an absolutely critical industrial metal that we need for, well, pretty much everything in the green energy transition and our tech-heavy world.
And this dual demand is creating a huge supply problem. We're about to enter the fifth year in a row where the world needs more silver than we can actually mine. This isn't just a temporary hiccup. It's what's called a structural deficit. It means the gap between what we need and what we have is just getting wider every year.
And this chart shows you exactly why that industrial demand isn't going anywhere. Just look at solar panels. They gobble up over 200 million ounces a year. Then you add in electric cars, 5G towers, AI data centers. The demand curve just keeps climbing. And here's the kicker. For a lot of this tech, there is no good substitute for silver. You have to have it.
The market is finally waking up to all this. In 2025, silver just exploded, surging nearly 120% after being pretty quiet for about a decade. A move like that isn't just a good year. It's a signal that the market is fundamentally rethinking what this metal is worth. And that momentum is carrying right into 2026.
Okay, let's completely switch gears and look at the other side of this tale. Oil. Because the story of oil perfectly explains that bearish forecast from the World Bank that we started with.
The story for oil is, well, incredibly simple. Supply, especially from countries outside of OPEC, is growing 3 times faster than global demand. And when you have that much more of something hitting the market than people actually need, well, prices really only have one direction to go.
And you can see it in Wall Street's forecasts. They paint a really clear picture. Analysts are seeing Brent crude averaging somewhere around $62 in 2026, with WTI even a little lower at $59. That's a pretty big drop from 2025 levels, and it points to a market that's just swimming in supply.
The charts are telling the exact same story. Since early 2025, oil prices have been stuck in this steady downward slide. Every time the price tries to bounce back, it hits a ceiling at a lower point than the last time. It shows you that sellers are in control and the path of least resistance is down.
So after looking at these two totally different market stories, what are the key things to keep in mind as we look ahead to 2026?
It pretty much boils down to three things. First, the wider commodity world is cooling off, and energy is leading that cool down. Second, precious metals are the big exception because they're being propped up by really deep structural demand. And third, the story for oil is all about one thing, a supply glut that's just swamping demand.
Now, before we wrap this up, it's really important we quickly cover the standard disclosures you'll hear with any kind of financial analysis.
First and foremost, you always have to remember that forecasts are just that. Forecasts. They're not guarantees. Markets can be wildly unpredictable, and just because something happened in the past, it's absolutely not a reliable guide for what's going to happen next. And it's so important to understand the risks, especially with certain products. Take CFDs, for example. They're complex, and because they use leverage, you can lose money incredibly fast. And as this disclosure shows you, a very high percentage of retail investors do lose money trading them. Always understand the risks before you get involved. And that really brings us to our final big picture question. This tale of two markets in 2026 highlights a major battle. Are we moving into an era that's going to be defined by that deep, long-term structural demand for really critical assets? Or will the classic boom and bust cycles of supply always end up winning out? That right there is the big question for the years ahead. Thanks for joining us.